Chapter 12, Loan and the Consumer. Let's start off by looking at a federal law that affects the lending process. Formally, it is called the Federal Consumer Credit Protection Act, but is generally known as the Truth in Lending Act. So this is a federal law that requires certain disclosures when a lender is extending or advertising credit. The whole aim of the Truth in Lending Act is to protect consumers. Regulation Z encompasses the federal regulations that implement the enforcement of the Truth in Lending Act. And of course, this act applies to all real estate loans. So the Truth in Lending Act was implemented by the Federal Reserve's Regulation Z. It requires the lender to show the borrower the cost of the credit. Those requirements include the amount that's financed by the lender, if there are any finance charges associated with that. Of course, that would include the interest over the life of the loan, plus are there any origination fees? Will anything be charged in points? How about mortgage insurance, as well as other applicable lender charges? That all has to be disclosed to the borrower. Also, something known as the annual percentage rate must be quoted. And of course, the total of all the payments made over the lifetime of that particular loan. Exactly what is the APR, or the annual percentage rate? That combines the interest rate with the other costs of the loan into a simple figure that shows the true annual cost of borrowing. The lender will quote a nominal or a stated interest rate, but because of monthly compounding, that stated or nominal rate will be different from the annual percentage rate. Therefore, the annual percentage rate must also be quoted to the borrower. The APR is higher than the stated or nominal rate because of compounding, because of that monthly compounding. 4 disclosures that must be prominently displayed on the papers the borrower signs are: what are the loan terms? The interest rate in terms of the APR, the maturity, and when the payments are scheduled to be made. The projected payments. How much will those monthly payments be? Of course, the APR, and what is the cost of closing the loan? The loan amount is the amount of credit provided to. There are certain transactions that are exempt from this lending disclosure requirement. The first exemption is for credit extended primarily for business, commercial, or agricultural purposes, and the second exemption applies to credit over $25,000 secured by personal property, unless the property is the principal residence of. A borrower has the right to cancel. They have a limited right of recession with certain terms. In other words, they can cancel a credit transaction as many as 3 business days after signing the loan papers to back out. Now that does include Saturdays, and it does not apply to credit used for the acquisition of an initial construction, for the acquisition or initial construction of your principal dwelling. And the reason why this right of rescission is included, it protects homeowners from certain home improvement and appliance salespeople that would be unscrupulous. So it gives them a chance to back out of those sorts of transactions. Now, according to the Truth in Lending law, if any of the following are mentioned in an ad, if there's any mention regarding a possible down payment, any payment at all, the number of payments, the period of payments, if there's a finance charge or a statement that would be sent out, or even if there is if it says no finance charge, if any of those terms are mentioned in an advertisement, that's a trigger term. And if that's the case, all of these additional disclosures must appear in the ad. What's the cash price of that item? Or what's the loan amount? Is a down payment required or none? What's the number, amount, frequency of the payments? The APR must be stated. And finally, what is the deferred payment price, or what is the total amount of all of those ongoing payments? Who must comply? Well, any person or firm that regularly extends consumer credit subject to a finance charge, and that includes charging interest, are payable by a written agreement in more than 4 installments. If that is the case, they must comply with these lending disclosures. However, the Truth in Lending Act does not include mortgage brokers or real estate practitioners that bring together borrowers and lenders, because they are not the creditors. They only brought the people, the borrowers and the lenders, together. They brokered a deal containing the financing. And after all, their names won't appear as the creditors. The lenders, the lending institution, will. And when it comes to the loan process, lenders must qualify the following in order to make a loan. They have to qualify the borrower. Can the borrower pay back the loan? They must qualify the property. After all, the property is serving as the collateral for that loan. If the loan goes belly up, then the lender is left with the property. And if sold, it must be sufficient to be able to extinguish that unpaid debt. And the lender would also qualify the title. Who has title to the property? Before we go into more detail into the process, let me introduce to you the concept of redlining. Redlining occurs when lenders refuse to make loans in certain areas. So regardless of what the structure's quality or value is, regardless of the borrower's ability to repay that loan, redlining is when lenders just refuse to make loans in certain areas. So it's a geographical limitation, and that's against the law. Loans are supposed to be made based on the value of the property, who holds title, and can the borrower repay that loan. So in qualifying the loan applicant, the lender will order a credit report on that applicant. That's going to provide the lender with a totally independent means of checking the applicant's credit history. And we know that the FICO score is what's really driving the access to credit in today's marketplace. The Fair Credit Reporting Act is a federal law giving an individual the right to inspect his or her credit file with the credit bureaus and correct any areas. It's suggested that a consumer checks their credit file often. However, and they are allowed to make corrections to errors. What a consumer can't do to their credit report is they can't delete material facts. And credit scoring is the method used today to evaluate credit risk. As I mentioned before, the FICO score is king. And the FICO score is published by Fair Isaacs and Company. And the score ranges between 500 and 850. The higher the number, the better your ability to take on additional credit and to pay any loans back to the lender. A score of 720 or higher is considered good. The Consumer Financial Protection Bureau is a bureau that was put in place after the 2008 financial meltdown, and it applies to all financial products. It qualified certain mortgage rules. In other words, their mortgages can't be longer than a certain length in time. They can't be more than 40 years in length. 5-year lenders offer fixed rates for a set number of years, and certain mortgages cannot have negative amortization. In other words, that means owing more than what you originally borrowed. The Consumer Financial Protection Bureau also put in play the ATR rules. That's the ability to repay. Does the borrower have the ability to repay the loan? And another measure that's used here is the debt to income ratio. The smaller this number, the better. New appraisal requirements are put in place for certain higher priced loans. There are new foreclosure requirements that lenders are now required to wait until borrowers are 120 days or more delinquent before sending an acceleration notice or filing for foreclosure. I believe we mentioned in an earlier chapter that lenders will try to work with borrowers if a borrower defaults in trying to work out either the terms or perhaps to try to get the property sold. But now there are requirements that borrowers have to wait 120 days or more that the loan is delinquent before sending an acceleration notice or filing for foreclosure. There are also new forms for the loan estimate and the closing disclosure. The loan estimate should be saved to compare with the closing disclosure. The closing disclosure is a statement of the final loan terms and closing costs. Of course, you're going to compare the two to one another, but that only occurs after you've made a loan application. So the loan estimate and the closing disclosure forms, you could probably find some examples of this on the internet. They're super easy to find, and they're not in the textbook. However, let's back things up and look at the Uniform Residential Loan Application. There is an example of that in your textbook, and you can go through all the different parts, but I'm just going to hit on some of it. First of all, in a loan application, it's going to be stated, you're going to state what type of mortgage is sought, and your lender will fill in the terms. The analysis begins, of course, with looking at the property and, as we mentioned before, who has title, as well as what's the borrower's ability to repay. In the loan application, the lender will also ask, what's the purpose of the property? Is it going to be owner occupied, or is it for income purposes? If it's owner occupied, it's been shown statistically that those loans are less likely to be defaulted upon. On the loan application, there's also several other questions that are asked. For instance, whether or not the borrower is married, what's their age, sex, and race. The lender can ask those questions. However, the Equal Credit Opportunity Act, which is another federal law, protects borrowers against discrimination. Those questions can be asked. However, the lender cannot make a decision based on those characteristics. Lending decisions have to be based on the borrower's ability to pay, the value of the property, and who holds title. On the application, the borrower will also be asked about their employment. How long have they been in a job? How stable is that job? And what is the borrower's regular monthly income? That is really important. And a borrower should state that income that occurs on a recurring or regular basis. You will also have to input, what's your housing related expenses, what's current versus proposed. You'll also have to disclose your assets, your liquid assets versus your illiquid assets. If you have any existing debts. And finally, what's your net worth, the difference between your assets and your existing debts. Unfortunately, we also know that there is predatory lending in our economy. That's when consumers lack the knowledge to evaluate lending practices and are preyed upon by unscrupulous lenders who take advantage of that lack of knowledge. And on the flip side, there is also what's known as mortgage fraud, and that almost always involves a conspiracy between a lender and an appraiser. But co-conspirators might also include like brokers, title companies, and sellers' agents. here are some key terms associated with Chapter 12. If you have any questions, let me know.